When purchasing a home, putting less than 20% down, you typically have to pay something called mortgage insurance. This is insurance that protects us as a lender in the case of a mortgage default. But today we're going to talk about some ways in which you can avoid mortgage insurance altogether without putting 20% down on that home. In today's market, it's not common to have 20% to put down on a property. And I speak to many clients who don't want to have to pay the mortgage insurance that's required when putting less than 20% down. This mortgage insurance is also known as PMI and is paid monthly as part of your mortgage payment. The ways in which you can avoid it are pretty simple. One, if you don't own a home now, just keep renting. It's an easy way to avoid mortgage insurance. You just make a rent payment. But on a serious note, the 4 real ways to avoid mortgage insurance are: 1, to either be active military or a veteran of the military. With a VA mortgage, you can borrow up to 100% of the property's value and not have to pay monthly mortgage insurance. 2 is we can break the loan up into both a first mortgage and a second mortgage. Because as we know, putting less than 20% down requires mortgage insurance, but that really only pertains to the first mortgage. So if the first mortgage is only equal to 80% of the purchase price, and a second mortgage is equal to, let's say, 10% of that purchase price, meaning you get to borrow 90% in total, you avoid the mortgage insurance altogether. 3 is you can do something called a single premium upfront mortgage insurance policy. This means that rather than paying monthly for the mortgage insurance and including in your payment, you can make a one-time payment at closing, typically added to your settlement costs, and it wipes away the mortgage insurance altogether. Now, this doesn't have to be added to your closing costs. There's actually ways in which that can be financed into your new loan. And the 4th way to avoid that monthly mortgage insurance is what's called a lender-paid mortgage insurance policy. In this case, you would typically take a slightly higher interest rate in order to avoid the monthly mortgage insurance. This avoids you having to add it to your loan amount or your closing costs. Essentially, it's covered by us as the lender for you taking a higher interest rate, resulting in a lower payment than what you would have had with monthly mortgage insurance. So if you're in the market to purchase a home and planning to put less than 20% down, it's important you speak with your lender to determine if any of these options fit your needs. I'm sure they can answer all of your questions and determine which one would be best for you.